Hello, everyone. David Thurman from Mortgage Choice in Barrick. It is Tuesday, the 5th of July, and the Reserve Bank, as widely expected, has increased interest rates by 0.5%. So in this video today, we will discuss why they've increased interest rates, and we'll also discuss how this might affect you. So as far as why they've increased interest rates, the biggest culprit is inflation. The Reserve Bank has been concerned about inflation for the last 12 months, and they finally started to act on it a couple of months ago, back in May, when they increased interest rates for the first time in 12 or 13 years. The only way that the Reserve Bank, or one of the main ways that the Reserve Bank can get control of inflation, is by increasing interest rates. The Reserve Bank likes to keep keep inflation at around 2 or 3% growth a year, and it's currently sitting at about 6 to 9% growth. So obviously there is concern. They want to get that under control, and so they're increasing interest rates to do it. In reading the Reserve Bank's notes today, it seems like they're more confident about getting it under control. They've actually mentioned that the inflation rate will be back under that 2 to 3% range by mid to late 2023. This is the first time they've actually come out and predicted that it'll actually be back under control fairly soon. So that's a good thing. And I think part of this video, I want to stress and to underline that the doom and gloom that you see in most media outlets, it's not the case. It's not as bad as everyone is saying it is. We've all expected interest rates were going to increase. We were at emergency levels for a long time, mainly because of COVID, and we're coming out of that period now. So we're recovering as an economy, and interest rates were always going to start increasing. All right. It's always a bit of a shock to the system when they do start increasing, but it's expected, and it's actually a good thing that they are going up. So how this will affect you. If you're a first home buyer, it means that your borrowing capacity is going to be reduced. So if we've talked recently about you, for example, purchasing something at around $600,000, this latest rate rise might decrease that by $25,000 to $30,000. So the best bet is to give us a call and talk through your borrowing capacity position, and when you're ready to go, to get a pre-approval in place, because most banks will lock in your assessment rate based on when you were pre-approved, and then you've got 90 days to find a property. And even if interest rates increase during that time, you'd still be assessed based on when you submitted the pre-approval and were signed off. All right. So if you're a first home buyer, pre-approval is a definite, it's a given. You need to get something in place. The other benefit right now that's floating around for first home buyers is the first home buyer's guarantee, where the federal government steps in and guarantees your loan. That allows you to reduce the deposit that you're putting down to only 5% of the purchase price. And it also allows you to avoid lender's mortgage insurance. It's not the same as the Victorian scheme, where the Victorian government is part owner of your property. I'm not a big fan of that, and most of the clients I've spoken to are not a fan of it either. But this federal scheme is much, much better. So it's the first home buyer's guarantee, HBG, I think it's called now, the new acronym for it. And it's good for established and for house and land packages. All right. So if you haven't discussed that option with us, give us a call and we'll talk you through it. If you're looking to upgrade, obviously the same with first home buyers, upgraders will be impacted because of the borrowing capacity being reduced. All right. So any purchase that you're looking to make, we need to discuss what your borrowing capacity is and take into account that we expect interest rates will likely continue to rise over the next 6 months. But as far as the property market's concerned and property value, it doesn't really matter what's happening in the property market, because if you're buying and selling in the same market at the same time, then you're going to balance out. It doesn't matter if the property market is hot or if it's cold, you're still going to balance out. So you should be fine. For investors, it actually feels like a very good time for investors to come back into the market. They've been sitting on the sidelines for a couple of years now because upgraders have kind of driven the property market up. But right now, investors are seeing incredibly low vacancy rates, less than 1% in a lot of areas around Melbourne. They're also seeing higher rent returns, and then the potential to buy into a market that's kind of going sideways and potentially down for the next 6 to 12 months would allow them to hopefully see some capital growth over the next 3 to 5 years. So investors, a great time to also take advantage of the equity that you've benefited from over the last 3 to 5 years, as all of our property values have gone up. If you're on a fixed rate, well done to you. A lot of clients have fixed in at around 1.8 to 2% back about 12 months ago when they were quite low. And if you've done that, fantastic. All I would recommend is that you jump onto the Mortgage Choice mortgage calculator online and punch in your current loan balance and an interest rate of 4.5%, and just see what the repayments are at 4.5%, so that you can be prepared when you do come off that fixed rate in a year or 2 years' time. You know what to expect, then it's not that big of a shock to the system. In general, I look at this as a glass half full opportunity for everyone. Right now, we want to curb inflation, so obviously interest rates need to increase. We're coming out of the emergency situation we were during COVID, where the economy basically sat back for 2 years and everyone stayed home and everything slowed down. We need to recover. It's expected that interest rates were going to rise, so this is just part of that process. So it's just all about, I guess, cutting back where you need to and reevaluating your cash flow, creating a budget, and just being better organized with your finances to offset these increased costs. The best way to combat higher interest rates is to ensure that your variable rate is as low as possible. Right now, variable rates will be sitting at a good competitive variable rate after this 0.5% increase. Should be between, say, 3.2 and 3.4%. So if you haven't spoken to us in the last 12 months and we haven't done a review for you in the last 12 months, then definitely give us a call and let's ensure that your interest rate is competitive. That is the easiest and the best way to combat these higher rates. I'm sure this will concern a fair few people where things might be a little bit tight. And if you are concerned about your situation and you want to discuss with us some ways that we can kind of alleviate the pressure that you're under, give us a call. I'm more than happy to chat and run through your options. Thank you very much for your time. The expectation is that interest rates will likely rise again in August and potentially a couple of times before the end of the year, but then it will plateau. At least that's what the predictions are. So good luck. Any questions, any concerns, let us know. Always happy to help. Thank you.